If you're living paycheck to paycheck, you are not alone. Nearly 8 out of 10 Americans have no money left over at all after paying for their bills. Now this is where you have a choice to make. The next time you get paid, you can either keep doing everything that you've been doing, which is making everybody else rich and keeping you broke, or you can do something different with your paycheck. That way you can take the first step to actually building your own wealth. If you're ready to make that change, you are in the right place, because in this video, I'm going to show you step by step the 10 steps that you need to do to stop stressing about money and never have to worry about money again by building the right systems with your paycheck. Step number 1 is save $2,000 as fast as possible. Right now, more than half of America does not have $1,000 saved up to protect them against an emergency. And with all the inflation that we have seen over the last number of years, things have become more expensive. And the reality is things will go wrong. Your car is going to break down, your AC is not going to work, your window's going to break, something's going to happen. And if you don't have a little bit of cash, we're just starting with $2,000. This is not the end goal. This is the starting goal. If you do not have $2,000, anytime something small happens in your life, number 1, it's going to stress you out. Number 2 is going to cause you to go deeper into credit card debt. And then number 3 is going to cause a whole mix of problems. So to avoid that, you need to have some sort of cash buffer that way when something bad happens, you can avoid all that stress because you're prepared for it. And then number 2, you don't have to worry about going deeper into debt because you have the cash to pay for the problem. You don't have to make it into a bigger deal than it needs to be. Step number 2 is you have to pay off your high interest debts, which include things like your credit card debts and your payday loans. Because if you have credit card debts and payday loans costing you 15, 20, 25, 28% a year, it is going to be impossible for you to ever build any wealth. I call this steps 1 and 2 the financial danger zone. So if you are in a situation where you don't have an extra $2,000 saved up, or you have credit card debt or those other high interest debts, you need to get extremely serious, and this is going to take the most extreme sacrifice in this stage. So if you are in this stage where you are still in steps number 1 and 2, no more eating at restaurants, no more going on vacations, no more buying any name brand stuff, and no more Netflix. Because right now you need to make some extreme change to see some extreme change. Now you're going to say, well, Jaspreet, why not Netflix? It's just $15 a month. Well, it's not about the $15 a month. If you don't have $2,000, if you have credit card debt, you need to do everything possible to cut back on your expenses and earn some extra money. That way we can get out of the financial danger zone. And the average American is watching more than 2 hours of Netflix a day. That's 14 hours a week, 60 hours a month, and we're talking about close to 1,000 hours a year. If you had suddenly an extra 60 hours a month, don't you think you could earn some more money? Don't you think you can learn a little bit more on how to invest better? Don't you think you can learn a little bit more on how you can attract more money through a business idea? Don't you think you can learn a little bit more on how you can spend less money? And this is where, if you are in this financial danger zone, you got to have a little bit of fire, a little bit of urgency here, because the reality is in this stage of your finances, you are making everybody else rich except yourself, because as soon as you go to work, that money leaves. It leaves your bank account to make everybody else rich. You're making Amex rich, you're making Visa rich, you're making BMW richer, you're making Gucci richer, you're making everybody richer except yourself. And you got to stop. Because the reality is, if you want to become wealthy, you need to keep that money for yourself. And if you keep giving your money to everybody else, you're never going to become wealthy. So you got to decide what's more important to you right now. Is it the comfort of having the 2 hours of Netflix and having the nice stuff and looking like you're rich? Or is it making some extreme sacrifice, looking like you're extremely broke? That way in a couple of years, you can be a lot more free and not have to stress about money. I'll let you decide. Step number 3 is you got to open 3 different bank accounts. Once you get out of the financial danger zone, now we can actually start talking about building wealth. Because when you're constantly trying to pay off your credit card debt, or you don't have any savings, there's no point to even think about passive income or investing, which is actually what a lot of those people end up trying to go for, which is really unfortunate because you're struggling with money. And when you're struggling with money, people on the internet start to sell you this idea of free money, passive income, make an extra $1,000 a month doing nothing. Well, that's not how it works, and they're selling you a scam, and then you end up into a deeper financial hole because you were desperate in that place. And so when you want to get out, you cannot bypass the hard work, but once you get out of the financial danger zone, now we can actually talk about growth and wealth. And in order to do that, you have to separate your money. Every wealthy person knows how much money they can spend, how much money they should be investing, and how much money they should be saving. And the best way to do that is to put walls, physical walls around your money that way you do not accidentally spend your investment money, so you do not accidentally spend your savings money. Because when you keep it all in one bank account and you have $1,000 in there, well, you go to the store and you see the nice TV on sale and you realize you have the money to buy it. You forget how much money is supposed to be saved and how much is supposed to be invested, so you just buy the TV for $942 because it was on sale, and then you realize, oops, I was supposed to invest. Well, I guess I'll do that next month. That next month, later, I'll get to it when I get to it, is what keeps so many people broke, and now we're going to build a wall for your money, and the wall is going to be 3 different bank accounts, and most banks are going to allow you to do this for free. If your bank is charging you money, get yourself a new bank. So what's going to happen is your money is going to be deposited here into your spending account. So as you get paid, money is going to be deposited into this account, and then you're going to create an automatic withdrawal and deposit to put some money into this account, which is going to hold your investing money, and some money is going to be deposited here into this account, which is going to hold your savings money. That way you're keeping the money separate. This is the money you're going to save for an emergency. This is the money that you're going to invest to make you wealthy, and this is the money that you're going to live off of. Now your next question is, well, Jaspreet, how much money should I be putting aside into these 3 different funds? Well, this brings us to point number 4. Step number 4 is to create a system for your money, and one of the simplest rules of thumbs that I teach is a 75-15-10 plan, which says for every dollar that you earn from here on out, 75 cents is the maximum you spend, 15 cents is the minimum you invest, 10 cents is the minimum that you save. So you make $100, $75 stay in here, your spending account. $15 go into this bank account, which is your investing account, and $10 go into here, which is the money that's going to be used for your savings. And the nice thing about this is whether you're making $100 or $1,000 or $100,000, it all scales. You're always going to put money aside to save. You're always going to put money aside to invest. And most banks are going to allow you to automate this entire process because you want this to happen without you having to think about it or without you having to do something about it. And I want you to think about this kind of like a tax. When you go to work and get paid, what's the first expense that you have to pay? Now you might say, well, I got to pay my mortgage or my rent or my car payment. Well, that's not true. The first person to get paid is the government. Because before you actually see that money, the government's going to take their money first. And the reason why the government does that is because they don't trust you. Because they know that if you had to pay your taxes at the end of the year, chances are you will have already spent all that money. So you want to allocate this money into the different bank accounts without you having to do something, because you want to treat it like a tax. Because the government knows that if you have more money, you're going to spend it. Well, if you take this money and you put it here and you put it here, you're going to spend this, but this money's already been allocated towards your investing money, so you can't spend it. And this money's been allocated towards your savings money, so you can't spend it. Remember, we're building walls around this. That way now you're taxing yourself, but now this tax that you're taxing yourself isn't to make the government richer, it's to make yourself richer. Because this investing is what's going to make you wealthy, and I'll talk about how you do it in just a minute. The savings are there to protect you against an emergency, because you got to have some savings to protect you. And the spending is what you use to eat and have a house and have a car. And you might say, well, Jaspreet, I'm already struggling as it is. How do you expect me to live off of 3/4 of every dollar that I earn? Well, again, think of it like a tax. If the government was going to raise your taxes by 25%, what would you do? Complain, scream, cry, kick? Well, and then you find a way to pay it. Because if you don't, you're going to end up in jail. Now you're taxing yourself, but not to make the government richer, but to make yourself richer. Now, for those of you that are investors or want to become investors, I want to remind you that I just put together a brand new investing masterclass where I'll walk you through how you can find hidden investment opportunities before everybody else. And I'll show you the exact system that my firm and I use to research investment opportunities and find them before they hit the headlines. It's a completely free masterclass. And when you sign up for this masterclass, you're also going to get access to Market Briefs, which is my newsletter for investors, complimentary, free as a bonus. So if you want to get the investing masterclass and get Market Briefs for free, all you have to do is click the link down in the description below to register. This brings us to point number 5. Know how you're going to actually put this money to work. That way you can build the most wealth for yourself. So remember, now you're working to get paid. Before, what most people would do is take the money and just spend all of it, which means you're making everybody else around you rich. You're making all of your banks richer. You're making all that stuff at the mall richer. You're making Amazon richer. Now you're going to use your paycheck smartly. And the first thing you did is got to get out of the financial danger danger zone. That means you got to save the $2,000. You got to pay off the credit card debt, and then you work to open 3 bank accounts so you could create a wall around your money. You create a wall around your spending money because that's the most you can spend. You create a wall around your investment money so you don't accidentally spend that. And then you create a wall around your emergency savings money. That way you have money there to protect you when that emergency happens, because we know that they happen. Then we created a system for your money, 75, 15, 10. That way anytime you get paid, money is going to be deposited here, and then you create an automatic withdrawal and deposit, so money gets pulled out and put into this bank account and this bank account, which is going to hold your investing money and your savings money. That way you have walls around your money. Now that you understand that this money is there to protect you, this money is what you used to eat, this is the money that's going to make you wealthy. So let's talk about how you actually invest your money. And there's a 3-step framework you want to follow. That way you can get the best returns. And step number 1 is pick which asset you want to invest in, because the reality is, if we take a look at the last 100 years, there are 3 assets that have built more wealth than anything else. That's starting a business, investing in real estate, investing in stocks. Now, investing in business can give you some of the best returns, but it takes the most time. It's not just an investment of your money. You have to actually create something, so it's the highest risk, highest potential return, most work, so I'm not going to talk about that. Let's talk about real estate and stocks. Real estate and stocks are 2 asset classes that are an investment of your money. You take your extra money, remember this money right here, and you're going to put it into that asset that's going to work to either grow or produce you cash flow. And even if you don't have a ton of money, yes, there are ways for you to get exposure to real estate. I'm going to talk about that in just a second, but you have to figure out where you want to start first. You don't want to do everything first. Start with one, get good at that, and then you can move on to the second investment, third investment, fourth, whatever it might be. But start with one, get good at that, learn it, and then work to expand from there. Once you understand which asset that you want to invest in, this brings us to step number 2 to investing your money, which is understanding how aggressive you want to be with your investment portfolio. There are 2 general frameworks that you have when it comes to investing in money. You can be a passive investor or you can be an active investor. A passive investor is something that's a little bit more hands-off. It's a set it and forget it strategy. So in the stock market, there are funds out there. These are called index funds or ETFs or mutual funds. It's just a basket of stocks. But the whole idea here is the way that you win as a passive investor is you're going to set it and forget it. You're just going to keep investing your money every week, every 2 weeks, or every month into these funds. With real estate, you can also invest passively, because now you're going to invest into a real estate fund. And you can find these on the internet. Now, instead of going out and buying a rental property for yourself, you're going to find a portfolio of properties that you can get exposure to by investing in that fund. And now sometimes you can invest with as little as $100, sometimes even $10, and you're going to create a set it and forget it strategy where you just keep automatically investing this investment money into that passive fund. Active investing is a little bit more different. This is where it's going to be more risk for more potential return. And with active investing as a stock market investor, now you're going to be investing into individual companies. Now maybe you're going to invest in Tesla or Amazon or Apple. And it's going to take more work, more time, but more also potential return. It comes with more risk, but the whole idea here is if you're willing to put in the work and time, you can see better returns because, well, you're investing in the better companies. But if you're wrong, the company could go bankrupt and you lose everything. So you have to understand which side of the game you want to be on. In real estate as an active investor, again, I'm not talking about trading or flipping. With the real estate as an active investor, you're going to go out and buy a property yourself, and then you're going to rent it out for rental income. So you're going to manage the investment, but you don't want to actually manage the property. You want to have a team. You want to have a property manager who's going to have contractors and other people in their office that are going to do the day-to-day work, but it's your job to make sure that this property is actually generating cash flow. So as an active investor, you're not actually trading or flipping, it's you're doing the work to manage and operate your portfolio. As a passive investor, it's more hands-off. And there are 3 types of portfolios that I talk about, being 80-20, 50-50, or 20-80. The first number is active, second number is passive. So 80-20 means you're 80% an active investor, 20% a passive investor. Again, the passive investing is what gives you the protection. The active investing is more risk for more potential return. 50-50 is 50% active, 50% passive. 20-80 is 20% active, 80% passive. This is where the people that don't like too much risk, but you still want to be able to get some of the upside by trying to find some of those companies with a little bit of that extra money that could see those big gains. So now you got to decide how much risk tolerance that you have. If you don't have a high risk tolerance, then maybe you do 20-80. If you're kind of in the middle, maybe you do 50-50. If you're okay taking on more risk, which especially if you're younger, like if you're in your 20s, you don't have a lot of financial responsibilities and you want to take on more risk, well then maybe 80-20 is better for you, but it just depends. Personal finance is personal. I'm not a financial advisor. I cannot tell you what to do. I'm just a random guy on YouTube. I'm just trying to get you to think like an investor, and then you figure out how you're going to actually put it into action. Because step number 3 is execute. So step number 1 as an investor is you got to figure out where do you want to invest, stocks or real estate. Step number 2 is you pick how aggressive you want to be, 80-20, 50-50, 20-80. Step number 3 is executing. So when you are a passive investor, the way that you win is by following a strategy I call ABB. Always be buying. Now remember, as a passive investor, you're investing into a fund. And now you want to find a fund that is a strong fund. So I'll give you a couple examples. Again, I can't tell you what to invest in, but if you wanted to invest in the total stock market, the United States stock market, there's a fund out there called VTI. If you buy one share of VTI, you're getting exposure to the United States stock market, the 2,000 some stocks that are in the United States stock market. And so if the stock market is going up, VTI will go up. If the stock market is going down, VTI will go down. If you want to get a little bit more niche, you can invest in the S&P 500, which is a group of the 500 largest companies in the stock market. So one example of a fund that gives you exposure to the S&P 500 is SPY. Again, now you don't have to invest in all 500 of those companies. With SPY, you're getting exposure to the 500 largest companies in the stock market. And now the way that you win as a passive investor is ABB. Always be buying. Every week, every 2 weeks, or every month, money is going to leave your bank account from here and automatically be invested into your portfolio of funds, and you set it and forget it. The key here, the way that you win, is you got to always be buying. That means next time we see a recession, because we're going to see a recession, you keep buying. Next time we see a market crash, because we're going to see a market crash, you keep buying. The mistake that so many people make is when things go down, people panic. Then they freak out and they sell. That's not the way that you win. You need to hold your composure, and the only change you might make is during those downturns, you invest even more aggressively. So as a passive investor, the way that you execute is by ABB, always be buying. As an active investor, the way that you execute is by looking at what I call a market shift. This is what my firm specializes in. We study these market shifts. We have analysts that do this full time that are studying where the money is moving, because if you can understand where the money is moving through your data, through your research, well then that can create an investment opportunity, especially if you can find this research before it hits the headlines. For example, during the pandemic, everybody was buying a cat and dog, right? We've all seen this. Well, if more people are getting cats and dogs, that means more people are going to need veterinary services. More people need cat food and dog toys and all that stuff. Well, that creates an investment opportunity because those companies that are selling those services are going to make more money. That can create an investment opportunity. That's what a market shift is. And when you can start to find and research those market shifts, now you're not trading or investing based off of what you see on CNBC and Reddit. You're investing based off of research and data, and you have some actual reasoning for making an investment. Again, the goal is to be a long-term investor, but you have to understand how and where the money is moving. This is, by the way, if you sign up for my masterclass, this is what I teach you. I teach you how we find these types of market shifts because it takes more work. So active investing, more risk for more potential return. Passive investing, less time, less risk, less potential return. Again, neither one is right or wrong. You got to find what's right for you. And the way that you invest your money successfully is to, number one, pick which asset that you want to invest in, stocks or real estate to start. Number two is figure out how aggressive you want to be, active or passive, 80-20, 50-50, 20-80. And then number three, execute. On your passive investments, ABB. On your active investments, find the market shifts. Step number 6 is to understand the different types of investment accounts out there. In the United States, when you invest your money, you have retirement accounts, and then you have pretty much everything else, your self-directed accounts. Retirement accounts generally are referring to things like your 401k or 403b, they all work kind of the same, and then your IRA. These are the government-sponsored tax-deferred retirement accounts, and then everything else would be like opening up your own Robinhood account or Schwab account or whatever account that you want to use. You're going to invest your money yourself in these accounts, or it could also be you just investing in real estate yourself or opening up a Coinbase account and investing in cryptocurrency. That is a self-directed account. Now, you have to understand what your goals are that we can find the best accounts for you. When you're investing your money into something like a 401k or an IRA, the whole idea here is to get the benefit of tax deference. What that means is when you put your money, and I'm just going to lump them two together, into this 401k or IRA, the way it works is your money is going to be invested into here, then your money gets to grow tax-free, and then you pull the money out. Now, you are going to have to pay taxes, but the taxes are paid dependent on what type of account that you have. So if it's a traditional, that means you're going to pay taxes on the back end. So with the traditional, money goes in tax-free, and then you pay taxes on the way out. So if you earn $10,000, all $10,000 can be invested into here. The $10,000 can grow, and then when you pull the money out, you're going to pay taxes on whatever that money grows to. So if it grows to $100,000, you pull the money out, you're going to pay taxes on the back end. Some people like that because they say, I'm going to have no income when I'm 65 years old, so when I pull the money out, I'll be in a lower tax bracket. The concern is, we don't know what tax rates are going to be like when you're 65 or 70 years old, so there's more uncertainty. And if you grow your income because you build a business or you build a lot of investments, well then when you pull the money out, you might actually have more income and could be at a higher tax bracket. And if the United States government needs more tax dollars, we could see tax rates go up. You can compare that to a Roth 401k IRA, works kind of the same, which is when you put the money in with this Roth, the money gets taxed on the front end. So if you make $10,000 and you want to invest that $10,000, you have to pay taxes first. And if you have an effective 15% tax rate, that means you take that $10,000, you pay taxes, which means about $1,500 is going to go to tax, and that means $8,500 is going to go into this account. I wrote that wrong. So $8,500 is going to go into your 401k. Now this money is going to grow tax-free, and then you can pull the money out, and now you don't have to pay taxes when you pull that money out. So if this $8,500 grows to 85 grand, it 10x's, well then you can generally pull that money out tax-free. That's the advantage of a tax-deferred retirement account. But there are some negatives to it as well. Number one is you can't pull the money out whenever you want because, well, if you pull the money out before you're 59 and a half years old, you have to pay a penalty, 10% generally, to break that and pull your money out. Number two is you have limited options on where you can invest your money because you generally have a few mutual funds or index funds that you can invest your money in. And then when you do that, you have to pay fees because your mutual fund and index funds have fees. And that money gets locked up there, so you have limited investment options. And number three, your tax deference is kind of limited to here. As you start to become more sophisticated as an investor, you can decide what is the right type of account for you. You just got to get started. Like for me, I don't use a 401k. I don't use an IRA because it's not the best vehicle for me. Again, personal finance is personal. I can't tell you what to do, but for me, it doesn't make sense because I can get better tax deference through real estate. And I can get better returns by investing my money myself instead of putting my money into these types of funds. So you got to figure out what's right for you. But if your employer is offering you an employer match, meaning let's say your employer is going to give you 3%, they're going to match 3% of your income into your 401k, and you have a 401k, well, if you're going to use that 401k, might as well take advantage of that full employer match because it's money that they're willing to give you if you're willing to invest more money. And if you're already using the 401k, well, you might as well take advantage of that employer match. So depending on where you are with your finances, you have to know the different types of account options. A retirement account is a great place to start. Yes, this 401k can count as the money you're putting aside towards your investments, but this account here is just the money that you're going to invest. Then you have to decide how you're going to invest it. And you can invest your money into retirement accounts. You can invest your money into real estate. You can invest your money into stocks. You can invest your money into more speculative things like cryptocurrency or startups. You can invest your money into your own business. You can invest your money into many places, but you've got to get started and just understand that the assets that have proven the test of time are stocks, real estate, and of course, starting your own business. Step number 7 is spend your money better. So we talked about how to create the system for your money. We now know how to invest your money. We talked about how to grow your wealth, but let's talk about how to be smarter with your spending because the reality is we live in a consumerism culture in the United States, and most people spend their money because they feel like they need to. But this is where I want to create a couple rules that we can be smarter with your money. Rule number 1, no more financing anything that does not put money in your pocket. That includes 0% APR. So if you want to go out and buy an iPhone, great. Don't finance it. You want to go on a vacation? Great. You better have the money to do so. You want to buy a Rolex? Great. Have the money to buy the Rolex first. If you have to finance it and it doesn't put money in your pocket, do not buy it. The only exemption to this is your house. And yes, that means when you go out to buy your next car, do not finance that BMW. And you're going to say, well, Jaspreet, I can't afford my BMW, my $50,000 car if I can't finance it. Well, who says you need a $50,000 car? See, the mistake with something like cars, people assume, we think that we need a car payment. And what happens when you think like that is you end up paying a triple whammy. Number one, you're paying interest on number two, something that's losing value, on something number three that has a limited lifespan. Because the car is not going to go up in value. The car is going to lose value. It's going to lose 18% of its value as soon as you drive that new car off of the lot. And then it's going to have problems. You got to pay for the maintenance, you got to pay for the insurance, and you're not going to drive it for the rest of your life. So you might think, I'm going to pay this car off in 5, 6, or even 7 years now. People are getting 7-year loans on their cars. But as soon as you pay that car off, what ends up happening to many people is, number one, you feel weird without a car payment because everybody needs a car payment. And then number two, this car starts to have problems. And you don't want to drive around in a car that's having problems. So now you want to flip it to a new car. And now you start the payments game all over again. And in 5 or 7 years, cars are going to be more expensive. So your payments keep going up. So you started off having $400 a month payments. Then it's $560 a month payments, then it's $700 a month payments, and then pretty soon now you're paying $1,000 a month for your car, and it never stops. And this is where I want you to think about that a little bit differently. When you go and buy that $50,000 car and you put $8,000 down, how about you take that $8,000 down payment, buy yourself a beat up Toyota, and now you don't have to worry about the car payments. You have cheaper insurance because it's a Toyota, not a BMW. You have cheaper gas because it's regular gas, not premium gas. And now you have a good, decent, reliable car. It doesn't look as nice, but you get to keep that $800 a month in your pocket. And now you can invest that $800 a month into your wealth. And we already know that $800 a month can add up to a lot of wealth over the long term if you understand how to control your spending. And then once you grow your investments, go out and buy them BMW or whatever car that you want without having to worry about the price. So rule number one is, if it doesn't put money in your pocket, do not finance it. That includes 0% APR. The only exception is your house. Rule number two, when it comes to luxuries, if you can't buy 5 of them, you can't afford 1 of them. You want a $10,000 Rolex? Great, be my guest, go out and buy it. Just make sure you have $50,000 first. You want to buy something nice, be able to buy 5 of them. And if you can buy 5 of them, well, now you can afford 1 of them. Step number 8 is earn more money. Once you understand the system and you start to get involved with your investments, you start to realize, oh wow, yeah, I can see the potential of my wealth building. I just want to be able to do more. And the first thing that a lot of people try to do, which is not a bad thing, this is a good thing, is you say, okay, I'm investing 15% of my income. What if I could invest 20% of my income? So now you start to live a little bit smaller, and that's all good. But there's a limit to how much you can cut back on your expenses. There's a limit to how much you can remove from your life. But there's no limit to how much you could earn. And the reason why I talk about spending here instead of first is because most people think that if I just made an extra $1,000 a month, all my financial problems will be solved. But it doesn't work like that. Because when the average person makes an extra $1,000, what do? They go to the Bahamas. They get a nicer house. They buy a nicer car. We buy more things because we think in terms of spending. But once you have laid this foundation, now you can have more power with this earning more money, because you understand as you earn more money here, more money is going to go into your investments, more money is going to go to your savings, because you have laid this foundation. This is when earning more money has the most potential to build you the most wealth, because you're going to use this money smarter. Because now when you earn that extra $1,000, the extra $10,000, the extra $100,000, you know what to do with that money. There's a lot of ways to earn more money. Look for ways to get it at your own job. Maybe look for ways to advance in your career. Maybe work to get a certificate, that way you can get a new career. Maybe you go back to school, or maybe you learn to create your own income. You start learning about artificial intelligence and you figure out how you can create some new income by teaching other businesses how to use AI. Maybe you start your own startup. Whatever you do, you work and earn more money, but the key as you earn more money now is you're earning more money, that way you can fuel the system, because this is what's gonna make you wealthy. It's not looking like you're rich. Most people want to look like they're rich before they're actually rich, because you want the BMW, you want the nice apartment, you want the nice stuff, so you can look like you made it, when in reality you're just making everybody else rich. Now when you're earning more money, you're not earning more money to spend it all, you're earning more money so you can invest more, that we can have more wealth first. Step number 9 is get some asset protection. As an attorney who's not your attorney, what I can tell you is, as you start to build more wealth, what people will want to do is take their hand, put it in your pocket, and take some of your wealth for themselves. And this is where you got to have the right legal protections in place, because the United States of America is the most litigious country in the world, and people want to sue other rich people, period. So this is where you got to create those shields and barriers around you using good attorneys. Get good accountants, because it can help you a lot. And the most basic things that everybody needs is, number 1, you got to build an estate plan, because The last thing you want is for you to die and your family starts fighting over who gets your money, and then the government decides where your money goes. So get an estate planning attorney. Maybe you create a will, maybe you create a trust. It's going to depend on where you are in your journey and what's important to you. But an estate planning attorney can help build that for you, that way you can allocate your money the way that you want. Number two, as you earn more money, you're going to want an accountant to oversee your taxes and your financials. If you are just working a job, you have no business, you have no investments, paying thousands of dollars for an accountant is going to be a waste of time and money. Now, maybe you want to spend a couple $100s on a service online just to make sure you're not overpaying on taxes, you're getting the best deductions, but getting an accountant at that stage is not going to be worth it. But as you start to layer in more investments, as you start to layer in businesses, now you need an accountant, and you want an accountant that's going to specialize in tax strategy, not just in filing your taxes, because if all your tax accountant is doing is filing your taxes, you are leaving so much money on the table. As somebody who has spent a lot of time studying the tax law, I can tell you that our tax code is a rule book. In fact, check this out. I keep a copy of the Federal Income Tax Code in my office. It's more than 2,000 pages long, and look at how small that font is. It is tiny. And what this tells you is the different ways that you can pay less money in taxes or pay more money in taxes. It's a rule book. So get a good accountant to help you with that. And then if you are investing your money into more speculative things, or if you are a business owner, you're an entrepreneur, get the right legal protection with the right attorneys. So protect yourself and protect your family, protect your finances by getting smart advisors to do that for you. And last, but definitely not least, is invest your money back into yourself and into your community. Give back as you build more wealth. But when I talk about investing in yourself, what I mean by that isn't just to reward yourself with some Gucci, but to really invest in your mind. And one of the things that you can do is just you watch more YouTube videos, listen to more podcasts, which are free. Then you can buy some books. Then you can start investing in classes. Maybe you get some coaching, but just invest in yourself. Invest in research, invest in data, invest in the things that are going to help you do what you do. If you are a business owner, invest in knowledge to help you accelerate your business. If you are an investor, invest in the right research to help you make better investments. If you are doing something, be willing to invest in yourself, because one of the best things that you can do is learn from somebody who's 10 years ahead of you, because then they can reduce their 10-year span to 6 months, because time is the most valuable asset that we have. So if you can pay somebody money to get that time back to accelerate your knowledge curve, you can get to where you want to go cheaper, faster, and easier by paying for somebody else's knowledge. So be willing to invest in yourself, and as you start to build that wealth, don't forget to give back and help others as well. So in this video, we talked about now how you can take the first step to build wealth through your paycheck, and the way that you can do that is stop giving your money to everybody else. How do you do that? By number one, getting out of the financial danger zone. Save $2,000 as fast as possible, get out of credit card debt, do whatever you gotta do to cut back and earn more so you have more money to get out of the financial danger zone. Then you're gonna create 3 bank accounts, one to hold your spending money, your investing money, and your savings money. Then you're gonna create a system, maybe 75, 15, 10, and you're gonna automate it. That way, anytime you get paid, money gets deposited into your spending account, some money gets put into your investment account, some money gets put into your savings account. Then, once you do that, you are going to understand how do you invest your money. And how do you invest your money? 3 steps. You're going to find which assets to invest in. Is it going to be business or real estate or stocks? Again, real estate and stocks are an investment of your money. Business is an investment of your time. Once you figure out which asset you want to invest in, you got to figure out how aggressive you want to be with your investments. You want to be more of a passive investor or active investor. We talked about being 80-20, active, passive, 50-50, active, passive, 20-80, active, passive. Once you understand how aggressive you want to be, number 3 is to execute. As a passive investor, the way that you win is by ABB, always be buying. As an active investor, the way that you win is by identifying those market shifts. Again, that's where my investing masterclass can help you identify those market shifts. I have that link for you down in the description. Number 6 are understanding the different types of accounts to invest your money. We talked about retirement accounts like a 401k and IRA. We talked about a Roth and a traditional 401k or IRA, how they work, and how that's different than a self-directed account, your own accounts where you're investing your money yourself. The key is you got to find the right options for you, because what's right for you isn't right for me. Number 7, you got to know how to spend your money smartly. Remember the 2 rules that we created. Number 1, don't finance anything that doesn't put money in your pocket. Number 2, the rule of 5. If you can't buy 5 of them, you can't afford 1 of them. Number 8, you're going to work to earn more money. That way you can fuel this system, because now you know how to actually build wealth. And now if you earn more money, you can get to that wealth that you want faster because you know how to use their money. Number 9, we talked about having the right protection by hiring the right advisors as you're building wealth. That way you can pay less money in taxes legally, you can have the right estate plan, and you can have the right legal shields around you. Number 10, take care of yourself. That's giving back to your community, investing in your own mind. That way you can accelerate your wealth and do what you want faster by learning from the people that have actually done it. So I hope you got a lot of value out of this video. If you enjoyed this video, the best thank you is a referral. So please share this video with a friend, a family member, a colleague, or a fellow investor. Thank you. In the early 1970s, the United States government had borrowed so much money. President Richard Nixon severed the tie between the United States dollar and physical gold.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
Now, if you notice what he said this was temporary, and here we are 54 years later, and the dollar is still not